Bob, do you have some views on that?
Well, I agree with Sandy. I think it's a very tough problem. Certainly many years ago, I felt that to stay with the historical rate of either receivables or long-term debt made sense, because if receivables were held until the time they're collected, or the payables exist until the time they mature, that historical rate of interest that was determined by the transaction price at the time the receivable or the payable arose will be the average rate of interest over the life of the receivable or the payable. Now, as you know, the study group on objectives have put considerable emphasis on relating things to cash flows. And I find out of that an analysis coming along that would suggest that in terms of cash flows, really the face amount and the stated rate of interest specify the cash flows, and that might be most closely correlated. So there's some sorting out to do, I think, with respect to both receivables and long-term debt. It's a very hot issue now, as Sandy's well aware. The SEC took some action right before the end of 1975 with respect to the municipal securities of the city of New York. And at the Financial Accounting Standards Board, we now have a project that is trying to come to grips with an appropriate accounting for receivables and payables. It's a very tough issue, I think.
Sandy mentioned replacement costs, and indeed a number of writers have advocated replacement costs, others net realizable values, still others combinations of the two. If one adopts replacement cost accounting, does this imply that the firm imminently might replace, or that replacement is a relevant decision to the firm in order for the resulting accounting measures to be useful to readers?
Well, I think it does not imply the replacement of the specific assets. It does tie in with the going concern concept, which contemplates a continuation in business of the enterprise. Now, we ran into this problem and will undoubtedly, as we implement Accounting Series Release number 190, which is the release by which we adopted the requirement for certain replacement cost disclosure. People came to us and said, when you speak of replacement of productive capacity, what do you really mean? And one of the interesting questions that came up was raised by the telephone company, where it said, when you speak of the replacement cost of productive capacity, do you mean what it would cost us if we suddenly were asked to go into a highly civilized, large country with 200 million people and no telephones, and we're asked to provide a telephone system like the one we have today? Is that the measure you want? And my reaction was, no, that isn't the measure we want. On the other hand, I didn't want the measure of what would it cost them to replace every single current facility that they have. And so we have said that in our release, we have said we want people to measure replacement costs in terms of the current business environment, the way in which they would replace. We have also said that if the company has made a determination that a particular segment of the business will not be replaced, they do not have to use replacement costs and merely make disclosure of the fact this segment of the business is not going to be replaced. And in effect then, that would suggest, I think, that that segment of the business be looked at as a liquidating rather than an ongoing enterprise.
Bob, do you have any views on that?
I generally agree. If we're looking at a company, let's say a steel company, a company in the steel industry, I think there's an assumption that they will stay in the steel industry and continue to produce steel. So replacement in that sense is assumed. But certainly I see no reason for assuming that it would be replaced with the particular machine that they might base a replacement cost on.
Suppose one were to talk, though, about net realizable values, what are sometimes called exit prices. Would an adoption of an accounting system, including mainly exit prices, imply an abandonment of the going concern assumption, do you believe? Is that an inevitable conclusion of using exit prices, do you believe?
I don't think it's an inevitable conclusion. It certainly is consistent with a liquidating enterprise that I think one might well argue that that would be the most relevant information for a decision maker if the firm was indeed liquidating. But it's hard to argue, I think, with Chambers or Sterling or others who've made quite a case for exit values that that's always kind of a relevant information for management and possibly investors. On the other hand, the thing that isn't convincing is that it's relevant to investors outside the enterprise who do view it as a going concern. That is, what is the relevance to an investor who's looking into a long-term investment, let's say as a common stockholder, of what the company might liquidate for this year? And that is the question that I think is not satisfactorily answered. I don't see any conflict. It's a matter of, is it relevant information for a going concern?
Sandy referred to Accounting Series Release number 190, calling for mandatory disclosures of replacement cost information by registrants. About 2 years ago, in a talk, Sandy discussed this topic and suggested that a requirement such as that might be a first step in perhaps a desirable direction. If one discusses or accepts the efficient market hypothesis, which believes or would say that the efficient market impounds into prices instantaneously and without bias publicly available information, at least a semi-strong form of the efficient market hypothesis would say that, would it be something we should conclude that this is the only step that needs to be taken, that it need not be made a part of the financial statements, if indeed that was the second step or the third step that you might have had in mind, that this is as far as one need go, is to make the information publicly available?
No, I don't think so, Steve. I think that it is important that the basic financial statements communicate as best as can be done the economic realities of the business. And I think that it is just much more efficient to communicate these realities in a statement format, so that you are looking, it seems to me, at more efficient communication when this gets into the statements. Now, it's true that a case can certainly be made that when there is footnote disclosure, that there is information in the marketplace and there is no need for more. But I think when one looks at accounting, one sees a system of communication which we want to improve and make as good as possible. And that's why I think that it is very worthwhile to consider what a logical next step is. How can you most effectively communicate the results of operations? And I believe, therefore, that it is appropriate to view this disclosure as a first step and to encourage the Financial Accounting Standards Board to move ahead with its conceptual framework project to try to develop the most meaningful financial statements which are the most effective communication devices.
I don't think I'll live to see the day when footnote disclosure is considered an acceptable substitute for measurement in the financial statements themselves. One reason, there are a lot of uses other than just trading in common shares that are made of measures of income and measures of financial position. And, just to mention a few, there are things like employee benefit plans and executives' compensation plans and debt indentures, and there's a whole myriad of uses made of those measurements. In addition, it seems to me important to remember, at least my understanding of the efficient capital market is this is strictly an aggregative result made up of a large number of individuals, many of whom may be naive, but nevertheless are using individual financial statements and arriving at something that has been called in the past intrinsic values or traditional analysis to arrive at their investment decisions. And that's a large group of people who demand to be served and are going to be served.
If you saw, Steve, the number of chief financial officers who appear in my office and express the deepest kind of concern about reported earnings and the greatest hesitation to use a footnote to explain why something is different than normal, it is clear that there are very substantial segments of the business community who believe that investors do look at the basic financial statements and do not look with care at the footnotes, and they are not at all inclined to present alternatives and footnotes and think that's just as good. And I guess I have enough faith in the fact that there are a lot of different executives out there who are responding this way to say that they are not irrational. Now, that perhaps indicates that I don't have total faith in the efficient market hypothesis.
Suppose we adopted replacement cost accounting in the financial statements themselves. Would you include holding gains, either realized holding gains or realizable holding gains in net income, or would you prefer to see them reported but excluded, or where would you stand on that position?
Well, one of the things that very much needs to be done is straighten out the terminology, and perhaps the most critical term that needs to be straightened out is what does income mean? I think there have been some very interesting suggestions in some of these recent studies that have been made, particularly by various policy-making bodies that you mentioned in your introduction, about breaking up a statement into, say, operating earnings and holding gains and extraordinary items, to cite the Sandilands report, for example. And maybe a lot of the what appear to be differences of opinion could be reconciled with just by a different structure of our financial statements. Now, I relate income to the economic notion of income, and I can't see a case at all for omitting holding gains. I see no difference between the retention and reinvestment of, let's say, retained earnings. And let's say this is, you retain it and reinvest it by expanding your plant. As a result, you have more money invested in plant, but it's a bigger plant with greater capacity. Now, what the difference is between that and another company that has to reinvest its holding gains, not to expand the plant, but nevertheless to maintain the plant. The dollar investment in both cases is the same, and to me that's the critical thing, not the productive capacity. So I personally have a great deal of difficulty of viewing holding gains as something other than income.
I think that largely I agree with Bob. I think the key is education of people as to what income is, and the fact that they are not looking for a simple handle that will tell all, which is what many people have viewed net income as. That's the bottom line, so to speak. Well, I think there probably isn't a bottom line when one is trying to analyze a company. The income statement is a source of information, not truth. And I guess I feel that probably analysts are most concerned with replicable cash-generating capacity. That has to be part of an income statement. There has to be data that will help people to understand that. At the same time, it seems to me appropriate to say there are items which are clearly part of income in an economic sense for the firm. And I think it's not illogical to follow a segmented statement approach, which will de-emphasize the single figure of net income, but at the same time reflect an income figure that reflects the economic realities.
If there is one thing I think that all of these groups have agreed upon is kind of the primacy of that first section in some statement, like current operating earnings, the sort of thing that one would expect. It's been described in some instances that if everything stayed at a steady state, you would expect that to be duplicated next year. I don't think any of these groups have differed with respect to that part of the statement of operations.
There's probably been too much emphasis in sort of above the line and below the line when one is talking about net income. And I think that if one looks to the future, I think the answer is in a segmented income statement of some sort.
So you think that one of the obstacles to progress in this area has been an attachment to the traditional notion of net income, that perhaps it means to too many people how much might be declared as a dividend as opposed to some kind of a measure of enhancement of the firm or whatever else it might stand for.
It's the focus on a single figure that somehow or other is supposed to summarize everything, and that's simply not a possibility.
Yeah, I remember when I was studying accounting in school as opposed to the way I study it today, and 20 years ago we had projects as to whether you had the current operating performance approach or the all-inclusive approach, and it was always debated as though there was an answer. And in fact, I guess the accounting literature has opted for the all-inclusive approach. But to me, it just doesn't make sense to say you've got to pick one or the other. It seems to me you've got to have a recognition of the fact there is no one answer.
Would this explain the disinclination of the SEC to include in the required disclosures under Accounting Series Release 190 an impact on reported income, perhaps, that this would rivet too much attention on a single figure?
Yes, that's true, and we point out in our release there is a section where we specifically caution against the simplistic use of this information. We think that it is useful information, but it is not a magical pathway to true income. We think that if we were to ask people to present what would be the effect on earnings per share of doing this, they would be, in effect, encouraging simplistic use, plus the fact it would require a great many difficult decisions as to what is income that we would just as soon leave to the Financial Accounting Standards Board. You know, what do you do with deferred taxes? What do you do with holding gains? There are a lot of different questions that come up.